Good evening, good morning, good afternoon, friends. After some seasonally normal volatility, suddenly the bipolar bears are back out of hibernation like they weren't near the verge of extinction the day before yesterday. So just in case you've forgotten,
your ATM is safe, your banks are safe, there's enough cash in the financial system, and there is an infinite amount of cash at the Federal Reserve, an infinite amount of cash at the Federal Reserve, an infinite amount of cash at the Federal Reserve, an infinite amount of cash at the Federal Reserve.
Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. Guys, if you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and it was just a mixed day across equities because things were very mixed, from yields to the dollar to commodities to even some of the economic data, and that was very reflective in the equity markets here today. There was nothing really to take your lead from when you look at this as a whole. One thing you can see is that Nvidia is starting to diverge from technology or the other semiconductor plays as a whole. Most semis were green, Nvidia was red. Energy was the worst performing sectors and defensives continue to be bid up. Utilities, healthcare was actually fairly mixed, but staples, another green day across the board. And you see what happened in the market much more clearly like this. Utilities and consumer staples, defensive sectors continue to be bid up, but we did see some cyclical and rate sensitive sectors at the top here as well. Discretionary and real estate, more so real estate on the rate sensitive side, but a lot of the retailers will benefit from rate cuts. And that's what we saw today. Defensive stocks, rate sensitive stocks outperform, and probably the stocks that will outperform in a Fed easing environment was at the top, coupled with stocks that you want to hold when things get tumultuous here in September into October. They were all green, by the way. Industrials and financials were also green, both up 0.1% respectively. And then we actually had these huge market cap weight sectors in the red. Stuff like communication services down 0.5%, tech 0.2%, healthcare 0.2% as well. And that's why the broad market did lose today. The majority of sectors were lower. The Nasdaq 100, the IWM, tech, small caps, the S&P 500, and the equal weight were all down anywhere from 0.4%, 0.2%. So a very tightly knit day. The only winner here was the Dow Jones, but it wasn't like that for the entire day. We actually saw circa 10:30, before the afternoon session, most stocks were actually up. Every index was up, but put in a top right here and formed lower lows, lower highs, and finished where we did here at the low of the day. About 2:30, 2:45, we actually did find a bottom and moved higher, and we actually didn't hit the lows of the day right here. So this is actually a higher low on an intraday basis. Diving a bit deeper into factor analysis, we saw the only green factors here was large core and small growth, but large cap value was down 0.4%. If we actually remove energy from the sector, they would have been in the bright green. Utilities, staples, financials, absolutely bright green, this sector right here. So this map isn't completely reflective of what actually happened in the market, but a very mixed day. But coming after yesterday's losses, it was always going to be a day like this where we're going to see a mild up day or a mild down day. Nothing too crazy, compression of volatility, and that's exactly what we saw. Look at large growth, only down 0.7%, small cap value down 0.044%, so not a lot of discrepancy between the two. And again, after yesterday's volatility, this is the type of stuff you get: a mild bounce back, a mild recovery. You're not going to have anything too crazy. Big moves normally happen in one day, and then things start to pair off as investors shake off the day that was. Looking at the global market, still red across the globe except here in South America. Kind of crazy what's going on there, but North America was red. Same too here with Europe, Asia, except the southeast part of Asia. This is like the semiconductor hub of the world. They were green, and I think that's because most semiconductors were actually green. Very interesting. Australia deep in the red, New Zealand slight green. All in all, a very negative day globally for stocks. Now, the economic data we actually got today didn't help the overall cause. We got very mixed economic data. The trade deficit actually slightly beat expectations right here. What the market was really looking at was actually the job JOLTS report, jobs openings. Jobs openings missed expectations ever so slightly, coming in at 7.7 million versus 8.1 million. But this report did have some positives. Jobs hiring and layoffs were actually more upbeat. We're going to talk about the JOLTS report in tomorrow's video, but this headline number is not indicative of what the JOLTS report actually was. It was a very mixed report, and then factory orders came in line, and very mixed data led to a very mixed day in the markets. Now, yes, equities were deep in the red. I get that. But if you actually look at stuff like commodities, gold, silver, they were actually up, particularly silver up 0.7%. Crude was down, and that's why energy stocks weren't that great. But then you look at stuff like yields. Yields were down, bonds were up, but then the dollar lost 0.48%. Now, diving into the S&P 500, something we look at every single day. Firstly, guys, let's not take our eyes off the prize, right? This is the year-to-date chart of the S&P 500, up 16%. So in aggregate, all of the volatility we're seeing right here, you know, some people saying it's the end of the world. It's not really. We're still up heavily for the year. And until we actually go ahead and break this low right here, you know, things are looking largely constructive. Yes, this is a lower high, I get it, but what really matters is actually the lower lows. If you make a lower high, you need to make a lower low, and there's a lot of selling the bears need to do to get there. They can do it, but I am hopeful for the most part. But diving into what we saw here with the gamma chart, very interesting. We saw a big move down from the 5550 to the 5520 here in the gamma flip. 5400 is now the put support, and the call resistance is now at 5650. For those of you that don't know, this line right here determines if we're in positive gamma. Above it, we're in positive gamma. Below it, we're in negative gamma. Above it, we buy dips, sell rips, because that's what dealers do to hedge their portfolios. They sell into strength, buy into weakness. And below it, we sell into weakness, buy into strength. We're in negative gamma. And the put support and the core resistance is simply our target zones. We are in negative gamma, which means we are looking to the 5400 area, which moved down from the 5450 area. That's not good at all. And we also saw the core resistance move from 5700 to 5650. So we saw a downtick in all of the major gamma chart lines. That is often bearish, and it does indicate further downside in the market. Maybe not before a little bit of a relief rally, but overall, this is telling us that we could see further downside unless the market tomorrow actually goes ahead and takes the gamma flip back into positive gamma and we close above it. That would be constructive tomorrow, but things not looking that great here in the after hours. The IWM, the SPY, and the RSP, you know, looking a little bit sick, but the Q is pretty much flat. I guess that is one positive, all things considered. But we are in negative gamma, and the plan right now is to look to the 5400 area as our target zone. We are also in negative gamma in the Nasdaq 100 as well as the RTY. We're in negative gamma, although just in the negative gamma. Looking at other indices though, the IWM doesn't look that great. You could see we put in like an equal low right here and a lower high. That probably means more downside for small caps and stuff like the IWM. The best looking chart right now is the RSP. If we go on a year-to-date chart, I mean, you look at this looks really strong. This is an all-time closing high, by the way, and we haven't seen as much downside volatility as, let's say, we have in the Qs. And our overall support line is this 171 area. If we pull back to this area right here, find support, and then make a move higher, right, that's just trend continuation. And look at all the space we have to form a higher low. We have up to the 163, 164 area right here. The RSP looking really constructive. If you guys actually want a ticker that mimics the RSP, look at something like the MOAT index, MOAT. They have this both on the ASX and the NYSE, so you can get it in the US and Australia. This is the MOAT. Essentially, it's like just wide moat companies trading at a reasonable discount to their fair value, or what Morningstar deemed their fair value to be. It's pretty much the RSP on steroids, right? It's sort of like you're getting these like mid-cap, broader market companies that are trading at a deep discount, and the constitution of this index is actually fairly robust. You get tech names like Google, Salesforce, Fortinet, UiPath, but you actually get a lot of industrials, financials in there. It's a great index, and it's actually compounded at about 14% every single year for the last 10 years. It's actually outperformed the S&P 500, pays a robust dividend, and you're just getting some high quality companies in the US. They have one for the global market. It's called GOAT as well. So these are the things I would look at if you're trying to get exposure in stuff like the broader market that isn't the Qs or small caps. that is what I would look at. But right now in the S&P 500, things are not looking that great, but things are not falling apart as yet. You know, when we really get to this 5400 area, that's when things get dicey. But you know, tomorrow we could literally retake the gamma flip because it did move down and then make our way higher. That could definitely happen tomorrow, and I do think we're going to see, but it's all going to be dependent on the macro. I think, you know, the market is just going to digest a lot of the data we got today. We got very mixed data. The jobs data was very, very mixed. The headline number came in bad. Looking deeper into the report, there definitely were positive signs, but it's all going to come down to the NFP report on Friday, guys. So sit through the volatility, guys. Build cash. I think more volatility is coming in September. I've said this throughout August. I said get ready for volatility. Have some cash ready. If you guys remember, I actually throughout August been selling a lot of my Visa position, generating a lot of cash. I'm still sitting on about 39% of cash, maybe a little bit more now that my portfolios have pulled back, but inconsequential. I'm sitting on a lot of cash, ready to buy a major dip when it happens, and you should do the same. Get ready to buy the dip because tops tend to be a process, bottoms tend to be short, sharp, and sweet. So get ready to buy the dip at a moment's notice. And yesterday's volatility turned sentiment on its head. We were sitting at the 65 region, somewhere around here. We've now moved from the greed zone into neutral. However, it's not all bad news because the first day of the month doesn't mean the full month is going to be a loss. You can see here in September, the first day was down 2.1% in the S&P 500. But when we normally do get a negative first day in the S&P 500, average monthly return is 3.4%. 72% of the time it's higher. And if we actually look at similar Septembers, we could see here that in 09, first day of September was 2.2%, a decline, but up 5.9% for the month. Every other September in 02 and 1974, when we had a negative first day, the full month actually had a negative return, and this does not bode well for the current September month. So if we do see further downside, history tells us that is the case, but if we look at the averages in total, we should actually move higher from here into the end of the month. But in years when the S&P 500 has returned 5% or better in the summer, September tends to be a fairly flat month. The real negative month actually comes here in October, which normally is down about 1.96% on average, 1.7% median, 6 wins, 17 losses. But we normally pay those gains very, very quickly because November and December tend to be very, very positive, above 2% in each instance for the full period from September to December, returning 2.78% on average, 3.85% median return, 17 wins, 6 losses. So the volatility we get in the next 4 to 8 weeks, you want to buy the dip because the returns tend to be quite stellar. And this is what the S&P 500 normally looks like. Circa late August into early October, actually get quite a violent pullback, but we par those losses very, very quickly. Tops tend to be a process, bottoms tend to be an event, and then we go higher, make new all-time highs into the end of December. And that's why I say you have to have a strategy, you have to have a plan, especially in election years where we do normally see quite a lot of volatility because of the uncertainty. So in light of all of this, how exactly do you hedge? Well, the very first thing you can do, especially looking 12 months out, is just buy bonds, something like a treasury. That way you'll get a consistent income. It'll also smooth out negative returns, especially going into rate cuts. You can see there's quite a wide dispersion. In 2020, 12 months later after the Fed cut rates, bonds had a 1% return. At the very high end, you can get up to 22%, but you're probably going to get the average return of about 10%. That's about what the S&P 500 returns, and this is great alpha, especially for something with relatively low volatility, especially going into rate cuts. I do know bonds can get very volatile into rate hikes, but for consistent income and something that's going to smooth out your returns, bonds are a great place to be. Another asset class you can look to is commodities, specifically gold. Gold, whether in a recession or not, tends to do really, really well. You can see average returns 12 months later of about 9%. At the very high end, if we do get a recession, you could see 21%. So gold could be a good store of value, especially if not followed by a recession. 18 and 24 months later is where we normally see outsized returns. All in all, this is a great place place to be regardless of what the equity market and the macro does, because your capital is in a real asset. Another fantastic way to hedge is simply just buying the dip. Equities tend to perform really well after Fed cutting cycles, especially if not followed by a recession. We could see returns 24 months later, circa 40%, average returns of about 26%. And if we actually look at the start of the Fed cutting cycle right here and what happens in the first 6 months, you can see that in every single scenario, we do actually get a bit of a drawdown after the first Fed cut, but we normally pair those gains and march higher, especially if not followed by a recession. Things a little different if we do get a recession, and that's why the market is so sensitive to the macro right now. GDP forecasts moved up to 2.5% after last week's data, and then after yesterday's factory data, we moved back down to the 2% region, still within the 2 to 3% range, looking robust, but teetering after yesterday's construction spending data that came in weaker than expected, as well as overall factory data. But regardless of what's happening in the day-to-day, the economy is still growing faster than pre-pandemic projections, so the economy actually accelerating ahead of analyst expectations. But everything this week is going to come down to the non-farms numbers, and both will actually see us posting a very solid August jobs report. They're expecting non-farm payrolls to increase by an average of 200,000 above the consensus, main driver being the moderation in jobless claims after a concerning uptick earlier in the summer. The unemployment rate should drop by a tenth to 4.296%, pretty much 4.3%, and the August jobs data will be pivotal for the speed of Fed cuts in the near term. That's exactly why the market is so keen on watching this, because it's going to determine if we're going to get 25 basis points worth of cuts or if we're going to get 50. This employment report is going to tell us exactly that. Now, the actual expectation for the non-farms is to come in at 163,000. Remember, Goldman is expecting 200K, the unemployment rate to come in at 4.2%, and then average hourly earnings to come in at 0.3. But that's on Friday. Tomorrow, on Thursday, we actually have some pre-NFP jobs data, challenger job cuts, the ADP numbers, as well as initial jobless claims. Then we also get the PMIs and some ISM numbers leading up into non-farm. So still a lot of stuff that can move the market from the data front, but not a lot from the earnings front. The only real thing we have on Thursday is Broadcom after the close, NEO before the open, and then UiPath as well. And then not much happening on Friday. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.